Did you know there's a legal, strategic way to deduct 100% of your real estate expenses, including the value of the land, on your rental property? Today, I'll walk you through a powerful tax optimization technique that involves using a trust for your kids and a lease buyback strategy. Stick around to the end because this approach could save you tens of thousands of dollars or more. Let's break it down. Typically, when you own a rental property, you can only depreciate the building, not the land. Why? The IRS considers land to have an infinite lifespan, meaning it doesn't lose value over time. But what if I told you there's a way to structure your ownership so you can effectively deduct the full value of the land and the building? Here's how it works. 1. Transfer the land to a trust for your children. 2. Lease the land back from the trust. 3. Deduct the lease payments as a rental expense. The first step is to transfer the ownership of the land into a trust, such as an irrevocable trust, with your children as the beneficiaries. By doing this, you no longer personally own the land. Instead, the trust owns it. And here's the key. This separation of ownership creates an opportunity for lease payments. Setting up a trust might sound complicated, but with the help of a tax attorney or estate planner, it's relatively straightforward. You'll need to specify the terms of the trust and ensure it aligns with your estate planning goals. Once the trust owns the land, you, the owner of the rental property, lease the land back from the trust. This is called a lease buyback. As part of this agreement, you'll pay the trust a monthly or annual lease fee for the right to use the land as part of your rental business. Let's break down an example lease payment. If the land value is $200,000 and the lease rate is 6% annually, your annual lease payment would be $12,000. These lease payments become a legitimate business expense for your rental property. And here's the kicker. Because the trust is a separate legal entity, the payments are fully deductible on your rental income tax return. Not only do you get to deduct the lease payments as a rental expense, but you're also transferring wealth to your children tax efficiently. The payments you make to the trust ultimately benefit your kids as the trust's beneficiaries. So it's a win-win. You save on taxes now, and you're setting up your family for financial success in the future. Of course, there are some key factors to consider before jumping into this strategy. First, professional guidance work with a CPA and estate planner to structure the trust and lease properly. Second, IRS compliance. Ensure lease payments are reasonable and align with fair market value to avoid scrutiny. Third, legal fees. Setting up a trust involves upfront costs, so this strategy works best for properties with significant land value. And finally, state law's rules around trusts and deductions vary, so make sure this approach is legal in your state. To recap, here's how you can deduct 100% of your real estate expenses, even the land value, on your rental property. 1. Transfer the land to a trust for your kids. 2. Lease the land back from the trust. 3. Deduct the lease payments as a rental expense. If you're serious about maximizing your tax savings and building generational wealth, this strategy could be a game changer. Be sure to consult with tax and legal professionals to tailor it to your unique situation. And if you found this video helpful, don't forget to like, subscribe, and share it with others looking to optimize their real estate investments. Thanks for watching, and I'll see you in the next video. Outro music plays as the screen fades to a logo or call to action text.